So welcome back to the first day of in-person activities. A few of us got out of bed. The rest of you, I don't know what you're doing, but I hope you're comfortable. We sure are. We've got plenty of room to spread out. And it feels good to have been outside for more than 15 minutes already today. So I'm pretty pleased. And if you wanted to know, I'm going to tell you today is my birthday. So as soon as I'm done with this, I'm going to go eat a nice meal that my husband is hopefully shopping for as we speak.
Happy birthday.
Thank you. Thank you. Thank you. Anybody else's birthday today? Anybody else's birthday soon? How about you guys online? Okay, fair enough. I should really know everybody's birthday so that we don't miss it, unless, of course, you don't celebrate. But anyhow, so in honor of my birthday, we're going to talk about one of my favorite subjects, the insurance solution. And I'm not really even kidding, because when we start talking about insurance, we get to what really launched my little career out of college. When I was in my senior year of college, I had really no idea what I was going to do for a living. I figured everybody would want me because I was really full of myself, and I thought I could get a job doing absolutely anything. And so I didn't bother interviewing. I had no internships. I just figured I'd throw a line in the water and I'd get some awesome job right out of the gate. Well, it turns out that it was a terrible job market. I wasn't aware. And I also had a great big surprise. I was pregnant and I had no intention of getting married. So I had a lot of interest in a very sudden fashion to find a job. And of all of the opportunities that were presented to me, the one that I wanted the most, because it seemed the most stable, was a job working for State Farm Insurance. And it was a 6-month interview process. And when I finally got through all of the stages, I still wasn't showing, so they didn't know I was pregnant and I wasn't going to tell anybody. They hired me, and it was maybe one of the happiest days of my life. I worked as a claim representative for State Farm in the auto claims department. And I went from being a mediocre student who wasn't really that focused to being a very attentive student the moment I landed inside State Farm. And I have to tell you that insurance is a very, it can be kind of a dicey discussion to have with people, because people can get very emotional about insurance, especially about brands of insurance. So some of you I know have probably had a bad experience with an insurance company, maybe with State Farm, maybe with American Family, maybe with Allstate. I've worked for a lot of companies, but I will tell you this, I am so biased towards State Farm. I drank the Kool-Aid there for so long that they can do no wrong, in my opinion. So I will talk about them as if they are a dear, dear member of my family, which they are. I worked there for 14 years. I went beyond claims, but I learned so much about insurance, and I was it was a perfect fit for me to work in that particular job at that particular time. So one of the things I hope to accomplish as we get deeper into the specifics of insurance is to help you understand a bit more about the career opportunities in insurance companies. They get a bad rap, I feel, because they're a little bit, I don't know, they're not particularly sexy. I mean, it's like, it's an insurance company. Everybody's going to assume you're selling something for a living, which frankly isn't the worst experience in the world to have. I don't think sales is such a bad gig. In fact, I did it for a while for State Farm. But there's more to it than sales. There's claims, there's underwriting, there's actuarial, there's marketing, there's investments, and more. And so what we're going to start to talk about today are some of these functions within an insurance company, but more specifically, or I should say more broadly, what does it mean to say that you're providing insurance or purchasing insurance? Because there's just a tiny bit of controversy there. And then let's talk about what is an insurable risk, what makes for a perfect risk to insure. And we'll talk a little bit about the law of large numbers. So today really begins chapter 6, which I want to remind you is not on the exam on Wednesday. So this, of course, is being recorded. We can come back to it. We will review some of the details of this chapter because you might be more focused on chapters 1 through 5, which I did post the review video to Canvas. So if you tried it and you had a hard time accessing it, you shouldn't have any trouble now being able to access the review that we did last week. So before I dive into chapter 6, anybody have any burning issues they want to talk about right away? Ellie? Yep.
Go over the variance equation.
Go over the variance equation.
Yeah, it's probably very simple. I don't know why, but I just lost it.
What I'm going to do is I'm going to follow up with a video on the variance equation specifically, because I feel like in order to cover that, and we're going to talk a little bit about it just because we're going to talk a smidge about the coefficient of variation and what that means. Hey, Austin, your mute is, there you go. I think I can do it for you. I'll try. So we'll talk about what variation means and the coefficient of variation. Anybody have anything else that they want to make sure we talk about regarding the exam on Wednesday? I'll be sending more details out via an announcement. It will be in Canvas. It will not be in the same system that you've been completing your homework in. It'll be like a regular Canvas quiz, completely open book. It's not open friend though, so you're expected to take the test independently. It's also, you know, you can use, obviously you'll need to click outside of your window if you're going to review the book, because the book is online, so that's fine. You can have notes or whatever. There will be a limited amount of time, so hopefully you're not showing up stone cold, which of course you're not, because you're here right now, which tells me that you're somehow engaging in the material. So making sure that you're prepared for it like you didn't have an open book or open note is going to make you very happy as you take the test, because you're going to run out of time if you're looking everything up. So anything else at all? Hey, Tin, I'm going to have you mute your mic, please.
Oh, I'm sorry.
No worries. Okay, so let's get started with chapter 6, which begins, as we talked about, the whole idea of using insurance as a solution to risk, because we know that insurance isn't the only solution. You can avoid risk as well. You can reduce it, but you can also transfer it. And one transfer method is using insurance. And so what is the definition of insurance? And it really depends on who you speak to. If you talk to somebody who's in economics or accounting, they'll say that it involves risk pooling and or a significant transfer of risk. So that might not necessarily be to an insurance company. But in general, the main theme with the definition is it's a change in who's responsible for the risk and who owns it. More commonly, the version that we use and that the book uses is that it's a social device where you have a group of individuals with a similar risk. The most common one that I can think of, and I like to go back to maybe the butcher, the baker, and the candlestick maker, who all live in a village with their houses, and that damn candlestick maker keeps burning the place down. So technically, he's got the biggest risk, but anybody's house could burn down back then because everybody heated with wood. So when you think about the most basic examples of using insurance as a social device, think back to fire insurance, where everybody had this risk that their big asset was going to become destroyed and that they were going to have to, by themselves, deal with this risk. Instead, we have the opportunity to transfer that risk to a third party. And of course, the third party for us is going to be an insurance company. That third party pools the risk exposure together. Means it takes all three. It's more than 3 houses, right? We need a lot of houses to really have a good pool. But when you have a pool, you're able to do a lot more, more accurate predictions as to what the costs are going to be. And that's why you want to pool risk, because you want to be able to use the law of large numbers to be able to increase the predictability of losses and therefore the stability of premiums. So we're going to talk about the fact that the premiums have to be reasonable or else people aren't going to buy insurance. Because your option, of course, is to have no insurance whatsoever. And so no money out of your pocket. And a lot of people gamble with many risks that we face every day. Like, I don't want to pay any premium for that. And maybe you choose not to pay a premium because, well, maybe if the risk happened, it wouldn't be a very big deal to you. Or maybe you don't pay a premium because you don't even realize you have this risk. But when you've decided you want to transfer this risk to a third party and let them pool it, then they take advantage of this law of large numbers. And they try to make sure that they have the ability to make these reasonable predictions and that they're going to be more accurate. Now, my example is going to fall on deaf ears because in this classroom, there's not enough of us to really justify this, but I'm going to give it a whirl. If you were here and if I had my camera on, I would show you, and I'm going to show this classroom. I have this weird I'm double jointed in my elbows. Is anybody else double jointed? Anybody online, or any of you double jointed in the elbows? Can you like whack out your elbow? Well, here's the thing. What if you did a sample? What if you wanted to know how many people in the world had double jointed elbows? And there are 4 of us in the room right now. And I personally, it appears that I'm the only one that has them. So we have 4 observations. We have 1 positive with double jointed elbows. So 25% of the population must be double jointed. Right. So I've got some head shaking in here because that's obviously not a very reasonable sampling. We're probably all a lot more in tune to the sampling that gets done with coronavirus. So if you were to sample a population of, 85-year-olds who had been exposed to coronavirus and determined how many of them for whom it resulted in it being fatal, you would get this huge fatality rate if we only sampled 85-year-olds. So the idea of large numbers is that the more observations, the more accurate our prediction about outcomes. And of course, it depends on what pool you're on the hunt for. But when it comes to insurance companies, they want a great big pool so that they can have reasonable predictions about what's going to happen. So let's also talk about how insurance works in general. And when we're talking about how insurance works, let's think about it from the standpoint of just between an insurance company and one individual. So if you've decided that you are going to buy a house, if you get a mortgage on that house, the mortgage company is going to absolutely require that you have it insured. But let's say you paid cash for it, but you're like, hey, even though a mortgage company isn't forcing me to get this house insured, maybe it's just such a big, for most of us, to have your house burned down to the ground, it'd be a big deal. And of course, it's insured against other things besides fire, but that's what we think about. And so we decide we're going to transfer this risk of losing the entire value of the house, and we're going to purchase insurance from an insurance company. So we're going to transfer that risk via contract. And it's a contract of adhesion. That term adhesion doesn't show up in this chapter, but it's going to show up in the future because we are adhering to whatever the contract is that the insurance company is offering us, which is why if there's ever any gray area with an insurance contract, if it's gray, it's paid. That's what we used to say in claims. If it's not clear who owes or what the coverage is, then it's going to be paid, because as a contract of adhesion, we are stuck with it. We're individuals, we're not experts on insurance, so we have to adhere to this contract that they offer to us. But we transfer the risk via contract. We give them money, and the insurance company gives us a promise. And that promise is during this time period from January 1 to December 31, in exchange for a premium, we're going to insure your home and it's going to be insured for X. And there's going to be more than just coverage on the house itself. There will be liability coverage, et cetera. But So we've transferred that risk for that time period via contract. Then the insurer pools all similar risks together. So we're pooled in there with a bunch of other people who also have homes. Now, in general, they're going to make sure that these are similar homes. Then maybe they will, maybe if they're sophisticated, they'll have a really detailed underwriting process, and they'll make sure that I'm in the same bucket with all sorts of risks that look like me in terms of, is my home brick or is it wood? Is it located in an area that's at risk for lots of hail? Or what are the property theft rates like in my area, etc. Now, there's no way that we're all going to be similar. We don't all represent the same risk because we're human beings. The person that lives in the house is probably the biggest risk. And as we've talked about before, credit scores or credit components of your credit report are going to factor into that. So anyhow, insure pools all similar risks together. And hooray, our societal risk is reduced as a result. Because now I have insurance. Could you imagine living next to me if my home burnt down to the ground and I didn't have insurance on it, and you're my neighbor and you got to look at my big burnt spot for a house? You want me to have insurance if I'm your neighbor. And so it not only reduces the risk of your property value staying high, but it also reduces all sorts of risks that come with, when bad things happen to your neighbor or to somebody else in your community, even if you don't know them, financially it could come back to you. So having insurance helps from a societal standpoint to keep things on an even keel and keep the wheels of commerce turning, right? We need things to keep moving. It's almost like having an emergency savings fund, but it's much bigger than that because insurance is intended to deal with catastrophes. And of course, we like stable premiums because then we can plan around it. We can have a budget. So if I didn't have insurance on my house, I would have to have a massive emergency savings fund to deal with that risk. And that money wouldn't be at work in my investments. Instead, I just pay a smaller premium and I transfer that risk. So then insurers compute their own risk of missing predictions, and maybe they'll want to make sure that they've got, a big enough amount of money in the bank over and above what the expected losses are, just as a buffer. And this is called a surplus. Some insurance companies have billions of dollars of surplus, and their insureds get upset because they're like, hey, reduce our premiums. They're like, hey, we need the surplus in case you people all have losses. And then, of course, insurance companies then segment according to risk for pricing and underwriting. And this is really where, they begin to discriminate. And it's using that term discriminate in the legal sense, in that we want to make sure that we are putting similar risks and pricing them appropriately. And I have an example of this I want to share. It's a tale of two insurance companies. Insurance company A, and let's talk about auto insurance for a moment. Let's say we've got auto insurance company A, and they are really lovely, well-meaning people. And they're simple. They're like, hey, let's offer insurance because we hate that. We don't like the idea of giving some people a better rate than others. So the most we'll discriminate by age. Let's say all 30-year-olds are going to pay the same rate for their auto insurance. And they've done their math and they know that a pool of 1 million 30-year-olds is going to have a number of claims each year. On average, 15% of that pool will have a claim. And each of those claims is going to average about $5,000 per claim. And so the expected claims numbers times the average claim severity means that pool of people in an average year are going to incur about $750 million worth of claims. I'm checking my math. Do it with me. So 1 million people times 0.15 is 150,000 times a $5,000 per claim average, 7 point, oh, sorry, 150,000 times, I don't think my calculator can go that big. Yeah, my calculator won't go that big, but 750 million per year in claims. Which means if I am just pricing to break even as an insurance company, I'm going to charge each driver 750 bucks a year. Now I'm going to have to buffer that to cover my expenses as an insurance company, but just to cover my expected losses each year, if all I'm doing is just turning around and charging on a per head basis, it's about a $750 a year premium, which doesn't sound horrible. I don't think, does it? All right. So, but then they've got competition, and in comes Auto Insurance Company B. And Auto Insurance Company B decides we're going to be more sophisticated. And actually, Auto Insurance Company B was started by a 30-year-old with a clean driving record. And this 30-year-old was like, that's bull. I should not have to pay the same premium as somebody who's got a terrible driving record. That's just not right. My twin sister is a nightmare of a driver, and maybe I'm clean, and so I don't like this idea at all. So instead, Insurance Company B does a little bit of digging and identifies that, okay, here we are, we've got the same pool of 1 million 30-year-old drivers, but it turns out that their research shows that half are going to have a clean driving record, and the other half have 1 or more moving violations. And of the half that's got a clean driving record, those guys will have 10% of them will have a claim that's 4,000 on average, or 200 million per year in claims. And so the average premium that you'd have to charge them without baking in any profit or surplus or expense load would be 400 bucks per year per driver instead of the 750. And the other half of the pool has 1 or more driving violations. Of that 500,000, 20% will have a claim, and their claim severity on average will be $5,500 per claim. So on an annual basis, their losses are going to be 550 million. And so to charge them the fair rate that they should pay according to Company B, they're going to pay $1,100 per driver. It is the same number. It's the same total number of claims, right? If you add 200,000 plus 550,000, we haven't changed the quality of the pool. We're just changing how we're going to charge people based on the risk that they represent. So if Company A had been in business for 5 years already, and Company B shows up with this rating structure, what is going to happen? What's going to happen? What's going to happen to Company A? A lot of things will happen to Company A. What's one thing that's going to happen to Company A? If Company B shows up and starts to offer this pricing difference between clean driving and those without clean driving.
People are going to switch to Company B.
Who's going to switch?
The clean drivers.
Oh. So this pool is going to get drained of all the clean beans, and they're going to come over here. Who's going to stay? What will Company A be left with?
Bad drivers.
Yeah, because they get a discount now, don't they, compared to what Company B would charge. And how long do you think it'll take Company A to figure out what the heck's going on? I don't know. Carly says not long. It depends on the company, right? I mean, it could take a full underwriting cycle or longer. before they really understand what's happening. And you can imagine that company B, because they're going to see how well this is working, they're like, this is fantastic. We are growing and we don't even have to market, because all we have to do is show up with our attractive rates. Hello, who wants to save some money? Everybody. Well, they save money on marketing, but they also are going to have better profits than company A, because company A is experiencing adverse selection, which is essentially just mispriced insurance. And it's mispriced. I mean, there's probably a lot of pricing errors in insurance all the time. And that's why it's a race to figure out how many different ways can we segment this pie? I mean, what other factors do we use to determine the rate you should pay for your auto insurance? We've talked about age, and we've talked about driving record. What else do we care about? Gender. Not fair, right? Well, it turns out it is, because you can prove it out. What else? What else do we care about? What other factors?
The type of car you drive.
Yes. So if you drive a Toyota Camry versus I gotta think of a good one. I don't know, a Maybach. What kind of car do you guys want? What's a really nice car?
McLaren.
A McLaren, okay. A Porsche, whatever. You get my point. So whatever car, I mean, really expensive cars that are like costly to repair, but also certain types of cars that have really powerful motors that can be an indicator that you're probably not going to be a super safe driver. What else? Yep. Credit score. Now, and I want to be careful because I use that term generically, but it's not the typical credit score that you think about. It's an insurance-based score. And so you might say, hey, my credit score is over 700. Well, that might be the case if you get your credit checked for the purpose of, buying a house or getting a loan. When it comes to insurance companies, they don't really care about that score specifically. What they care about are components of your credit report. Because if you ever run your credit report, you'll see it shows how often you pay your bills on time and how often you don't. Do you ever exceed your credit limit? How much credit do you have, etc. So your insurance company has their own secret sauce because they've got the actuarial bandwidth to be able to figure out what components of your credit report are going to be the best predictors of something that's going to give us, a leg up on another insurance company. Any other factors that you can think of that drive, Anthony? Location. Yep, your zip code is a big deal. Have a car garaged in Chicago versus in Park Falls, Wisconsin. OMG, huge difference. Wisconsin is one of the cheapest states in the planet, cheapest states in the US to have auto insurance. And Chicago is one of the most expensive. Now, if you're going to be an insurance agent, where do you want to be? Chicago. I mean, because it's big premiums. Any other factors that you can think of that you might slice that pie with for auto insurance? We've hit most of them, but there's one other that it's pretty common. Anybody online have any ideas? I'll give it to you. It's usage. So one question they'll ask you is how many miles do you drive to work each day? Everybody lies, about 2, 3. They'll find out, right? Now, if you lie, generally it doesn't void your insurance coverage. It just means when they catch it, they're going to jack up your rates. There are other lies that you can tell that are material and they will cancel you. But anyways, So that is the big idea of this particular section. You know, we've talked about transferring the risk. We've talked about risk pooling and the benefit of the law of large numbers, how we discriminate, and that's the essence of pooling. Because we want to avoid, if we're the insurance company, we want to avoid adverse selection. And this is a tightrope to walk because, you know, now more than ever, we are all very sensitive to the idea that we might not be fair in the rates that we charge. And insurance companies have a history of doing naughty, you know, underwriting practices that didn't have the data behind it. Now they've got the data behind it. And it's a race to get the most, the deepest, the broadest knowledge that we can get so that we can find ways to slice this pie as thin as possible. Because we want to, if you're the insurance company, you want to put this company down, right? It's a competition. How can I hose my competition? Well, I'm going to do it with better, more precise rates. I'm going to cherry pick their best customers. That's who I want. And so that's it. But you also have companies that are saying, hey, you're overcharging your bad drivers. You could be getting some of these risks that other companies think are terrible, and you could be attracting them and finding that, hey, they're not so bad, as long as you know this one little secret to look for, right? Whatever it is. So it's all a matter of looking for opportunities to beat the competition by offering more customized, segmented rates. Okay. Any questions on that? Let's do a quick quiz, shall we? Oh, it's not going to let me. All right. Oh, this is mean. I should probably do this first. One comment on, you know, we talk about testing and we talk about some of the stats that we look at in this course. I'm not going to ever test you on this, but I want you to at least be familiar with these terms and know that the whole point of trying to get to you know, to risk pooling in the law of large numbers is so that we can have more certainty, less variation in the expected result. Insurance and finance use these terms all the time, you know, where you've got standard deviation being an absolute result of how far spread are all of your possible results from the mean. Whereas the coefficient of variation just adds a little bit of scale in there. And that's all it's attempting to tell you is how much variation can we expect? And the bigger our sample size, the less variation we can expect from the standard, from the mean, or from, if we're talking about finance, the expected return. So you look at a stock, maybe a mutual fund, you might see an expected return over time of X, but of course, the spread is pretty big. It could be in the negative or it could be in the positive, but the expected return being sort of what brought you to the dance to begin with. But if your variation is broad, that's scary. If your variation is narrow, that's not so scary. And so what we're looking for is a much bigger pool of data in order to get a sense of confidence on whether or not our results are going to be predictable. So I think that this quiz, so I gave you a flash of the equation, but I would not put this on a test, but we'll just have for fun, it's a 50-50 chance. The coefficient of variation, true or false, is calculated by dividing the mean of a sample size by its standard deviation. Did you look at the formula long enough? What was on top? What was on bottom? These are the two factors. Here, you got it. Because the right formula is standard deviation divided by the mean of the sample size. All right, which of the following does not characterize insurance? This is another mediocre question, but let's just go through these individual. True or false? Does it provide economic security? Oh, that is true. True or false? Guarantees wealth above the loss.
False.
Yeah, you got it. When we are pretty certain that the future will be similar to the past, a blank can be used to predict future loss. Which of these fits? If you read that whole statement, and I think you'll work your way into ruling it out. We've got a vote for loss distribution. Anybody else feeling confident about that? I'm feeling confident about it. Yes. What is the law of large numbers? Why do insurers rely on the law of large numbers? Let's start from the bottom. Is this true or false? We cannot prove the law of large numbers. False. Correct. True or false? Insurers rely on predictions, not the law of large numbers. That's false. Correct. As the sample size declines, the standard deviation is getting smaller and insurers want to predict correctly. Wow, totally false. It is a mathematical phenomenon known to improve expected losses. False. I mean, it's a mathematical phenomenon known to improve what? Predictability, right? So that leaves us with, as the sample size increases, the standard deviation is getting smaller and insurers want to predict losses correctly. All right, identify the element of insurance that uses the law of large numbers to reduce the possibility of missing future loss predictions. I'm gonna give this to the people online. So somebody from our online team, tell me, which of these elements of insurance uses the law of large numbers to reduce the possibility of missing future loss predictions? I'm gonna pick on one of you, you know. Safa, what you got? Okay, somebody help Safa.
I can volunteer.
Awesome.
I would choose risk pooling because
Yes, because
okay.
why?
I was worried about that noise. Yeah, because they're getting more and more people into the insurance, lowering the standard deviation, and just like combining it. I don't have a good explanation for it, but
You did. That was a perfect explanation. That noise was glee. Thank you. Thank you. All right. Number 6, because insurers need to blank exposures according to expected losses, a person with diabetes will be charged a higher premium than one without any medical condition. Because insurers need to blank exposures according to expected losses, a person with diabetes will be charged a higher premium than one without any medical condition. You'll be sick of this word. That sounds like a good one, doesn't it? But what else could fit there? Yes. Pull, pull, pull. Law of large numbers. Pull, pull, pull. You're going to be sick of this. Only because this is the crux of this particular section. Any questions on any of those? All right. Let's move on. Where are we at? Oops. So moving on to the next section. The ideal requisites for insurability. An insurance company can't insure everything. There are some risks that are just like, there's no way that they can get some of these features to apply. And in order to have a successful insurance company, you need to stay solvent. And to be solvent when it comes to insurance, you need, number one, you need a big number of exposure units. So when you think about some rare, and you can find insurance companies that are willing to take on the unusual risk exposure, but on average, insurance companies want to see a large number of similar risk units. And they need to not all be exposed to the same type of loss. And in your book, they talk about this company really often, this Athenium Analytics, which essentially is, among other things, satellite software that helps score homes on their likelihood of damage, or the how much risk they represent for damage to hail. Now, hurricanes get all the glory when it comes to big storm losses, but hail, little old hail, does more damage on an annual basis than hurricanes. On an average year, hail is the big winner, so to speak. So insurance companies will use this data to make sure that they're not overexposed to units in too tight of an area, or that's to units that have too much exposure to one particular peril, like hail. Another example would have been fire losses in, within cities. So you had some insurance companies that were only located in major cities, and their exposure to fire damage was unbelievable, because if you had a fire downtown and you insured half the downtown, that's a problem. So you need a lot of exposure units, and you need them not to all be sort of interdependent. And the losses need to be accidental. And when we talk about accidental losses, the thing that I think about all the time, because I saw this all the time, is that stupidity is covered. Even my own. Thankfully, I didn't burn my house down, but it was just this summer, I was hard boiling eggs, and I don't know what got my attention. It must have been amazing, because by the time I remembered that I was boiling eggs, the pan was already my kitchen was filled with the most horrific smell. If I would have burnt my house down from that, I guess technically, that's an accident. But, I suppose if you've got criminal intent, you could do the same thing, right? You could hard boil some eggs and leave them unattended for an extended period of time. And unless the insurance company can prove it, it's covered. But losses that are accidental is what they intend to insure. And we know that we all do dumb things and we might be negligent, but in general, those are covered. What's not covered, things like poor maintenance. So you'll hear this term when it comes to a claim. You'll want it to be sudden and accidental. Another example where this comes up is if you've got, let's say, an old roof. You've got a roof that needed to be replaced 10 years ago, right? And it has been leaking like crazy. You didn't know it. And maybe you bought the house in that condition. You even had an inspection and the inspector didn't see it. But by the time the next storm comes, the whole thing collapses because of old shingles and the failure to maintain the roof. That is not a covered loss. It's not a covered loss because it was a maintenance issue. Now, if the roof, again, had been in, let's say it was in bad shape, it needed to be replaced, but it got struck by lightning the day after you moved in. Even if the roof was in terrible shape, you're going to get a new roof if you had replacement cost coverage because a lightning strike is a sudden and accidental loss. If that was the proximate cause of loss, that would be covered. So losses that are accidental to you, but again, the cause of loss can't be poor maintenance. Now you might have an insurance policy that says, look, we will pay to replace whatever damage was done back to the condition it was in before the accident. So if you had a 30-year-old roof, they might not really owe you much, but most policies nowadays have replacement cost coverage. All right, so losses that are accidental is what they intend to insure. Number 3, this is sort of a strong statement. Catastrophic loss cannot occur. Well, or at least it's a small chance of a catastrophic loss. And what we're talking about here are losses that would ruin the company. They want to make sure that they are insuring a pool of risks that are not highly correlated. So that if you had all your whole book of business was sitting on top of, well, it's a bad example to say that we're sitting on top of a fault because because earthquake coverage is excluded unless you add it specifically. But let's say you're an earthquake insurance company. You offer a lot of coverage and you also include earthquake coverage as an additional exposure. You'd want to be very careful to limit how many homes, if you're a homeowner's insurance company, you're going to insure to avoid a catastrophic loss. A more common example of this is what happened with 9/11. So before 9/11, commercial insurance policies covered acts of terrorism. Most did. After 9/11, it is gone. There is no longer coverage for acts of terrorism. And that is because before 9/11, we didn't really understand how much loss could happen. And so that catastrophic loss exposure is no longer insurable. The other factor is that losses need to be definite in time and measurable in loss size. So our ability to determine exactly when it happened is important because we need to determine whether or not your coverage was in place when it occurred. So if it was a lightning strike, knowing what time the lightning struck, if it was a fire loss or a liability claim or a motor vehicle accident, most of these losses have a very specific sudden and accidental event nature to it so that we could pinpoint to the time of loss. And we need that because, again, that contract is in force, and what's triggered, what triggers coverage and determines coverage is when did the loss occur and was the policy in force at the time that the loss occurred, not at the time the claim was presented. So you could have, and this is important because there are other coverages, including medical malpractice insurance and errors and omissions liability coverage, that's based on claims made. So it's when the claim is presented for some types of coverage. But most coverage that you and I are going to purchase for our homes and autos, those are based on occurrence. So you need the contract to be in force when the loss occurs, which is why they need to, why that needs to be definite in time and our ability to measure the loss. Because that's what an insurance policy gives is money, right? Now, it's not a guaranteed amount of money all the time, but there's a policy limit almost all the time. So those two, critical. I just want to see if they had any other good examples of it. We also need to be able to have some reasonable confidence that we can determine the probability of that loss occurring. I used the example last week of sinkholes. Sinkholes are horrifying because when they happen, they do so much damage. Some of the most spectacular pictures you'll see are of neighborhoods that were destroyed by sinkholes, which could be caused by a number of things. Usually, not usually, occasionally mines, old mines that were dug and with no evidence left behind that they were there. But it's very difficult to determine the probability of a loss resulting from sinkholes. We just don't have the data. And they're not predictable. It's not like weather patterns or anything like that. So when it comes to a loss like sinkholes, there's no probability distribution that can determine their likelihood of occurring. Therefore, they are generally excluded. Now, in some states like Florida, they've added it as a requirement. If you're going to be an insurance company in Florida, you've got to put it in your policy. And then finally, the cost of coverage must be feasible, which is just saying, if we are going to offer insurance coverage for something like, let's say we could figure out what the probability distribution was of sinkholes, and to be confident that we weren't going to let sinkholes ruin us, we're just going to have to charge everybody an extra $10,000 a year on their homeowner's insurance policy, just so that we could protect the handful of people that actually had a sinkhole claim. Well, then I would say that coverage isn't feasible. And depending upon the type of risk, if you're going to charge somebody an excessive amount of premium for their coverage, they're going to be like, no way, I'm not paying it. And then it's not going to be, there's no point in attempting to insure something or attempting to offer that coverage if it's not going to be economically feasible to the insured. And this comes up all the time where you're like, well, first of all, I am not going to pay $30 to insure a $200 printer, right? When they offer you coverage on your inkjet printer. I don't know if any of you own a printer, but I would not buy the insurance on that. Another example that's used in the book is the cost of an insurance deductible. So if you've got a collision deductible on your auto insurance of $100 per loss, meaning if you have an accident, you pay the first 100 and your insurance company will pay the rest, versus, and they're like, hey, why don't you just raise your collision deductible if you want to save some money? You're complaining about your premium. If you'd raise it to $500 per loss, we'll reduce your premium by $85. I'm making this up. Everybody's going to be different and depending upon your car. So essentially that $85 was insuring the gap between 500 and 1,000. So it was essentially providing $400 worth of insurance. I think that's a pretty bad deal personally, but so making sure that the cost of coverage is feasible, well, it depends on the individual. You decide what's feasible to you, but most insurance companies aren't going to bother offering policies that are not economically feasible. If they were intended to be offered to lots and lots of people, they've got to find a way to limit the coverage in a way that makes it still valuable and feasible. All right, let's do a quiz. Which of the following statements about insurance is not true? This is a terrible question, I'll tell you that right up front. Some of them are pretty obvious. Number one, true or false? Insurance premium rates are based on predictions of the future, which are expressed quantitatively as expected losses. Is that true or false? Anybody online want to give that a whirl?
True.
Exactly. In many cases, insurers promise to pay in dollar amounts for losses if they occur during a particular time and in a particular geographic area. Is that true or false? Yeah, I think this is the one where they have the wording in a way that maybe the authors of the book thought that one should be false, but let's move on to the next one. In general, I would say that one was true. Exposure units are susceptible to dependent loss when loss to one exposure unit invariably results in the loss of another. Now, technically that sounds pretty right, but we'll see what the authors say. If losses cannot be predicted with reasonable accuracy and confidence, it is impossible to determine insurance premium rates, the size of surpluses, or the net worth required. True or false? Yes, true. So we're left with only two that are questionable. And the one that the authors wanted you to pick as being the false one is, and I believe that this one is marked as false because promise to pay in dollar amounts for losses if they occur during a particular time and in a particular geographical area. It's not necessarily in a particular geographical area. I think that's their nitpicky one. But if you have other thoughts on it, you can share them with me in the chat. All right, true or false? If the losses the insurer pays plus the cost of insurer operations are such that the premium must be very large in relation to the potential loss, insurance is economically feasible. True or false? We just covered this, and if it sounds wonky, why? Why does that one not sound right? It's a 50-50 chance. What do you guys think?
False.
I like that confidence.
Thank you.
You're welcome. So the whole point of this is that if the premium has to be very large in relation to potential losses, then the insurance is not economically feasible. So you're correct. Insurance companies use cost-benefit analysis to determine whether they should bring a new product to the market. We didn't cover this, so you got to use your common sense. What do you think? Would insurance companies use a cost-benefit analysis to determine whether or not they should bring a new product to market? I saw 2 nods.
True.
I mean, it's not really that different from any other company. All right, we talked about this one. Which of these perils is generally difficult to insure? Terrorism. Correct. Now, I will say that mold is mold is right up there because nobody really wants to insure mold. Oh my God, that's horrifying. It's so expensive to remediate mold and so many issues, but you're right, it's terrorism. Which of the following requirements of insurance influences the consumer demand for insurance and looks from the perspective of potential insureds? So of all of the things on that list that make for a good insurable risk, there was one specifically that's really from the standpoint of the customer. Which one of these is from the standpoint of the customer? So when we talk about potential insureds, we're talking about customers. So which of these requirements of insurance influences the consumer demand for insurance and looks from the perspective of potential insureds? Yes, the cost of coverage is economically feasible. You know, when you think about from the standpoint of the insured, does the insured care if the probability distribution of losses can be determined? I mean, they hope you know what you're doing. The number of similar exposure units is large. Again, this is from the customer standpoint. They're like, hey, look, you're the ones running the company. You should know this. The losses that occur are accidental. That's a little gray, but, you know, as the insured, you're like, come on, would you, you know, I mean, they expect that losses would be accidental, but the cost of coverage being economically feasible is definitely something that looks from the standpoint of the insured. True or false? The concepts of mass and similarity are considered before an insurer accepts a loss exposure. True or false? How about somebody online? What do you guys think? You're welcome to put it in the chat if you don't want to take your mic off.
Would it be true because they want uncorrelated losses?
You are correct. And that term uncorrelated is a really, you know, that's spot on.
Thank you.
Insurable losses must be fortuitous. How many of you have been using the word fortuitous improperly? I've used it improperly. When you hear the term fortuitous, don't you think it sounds like fortunately? It's not. It's not, doesn't mean good fortune. What does it mean? Insurable losses must be fortuitous. That is,
Not planned out, like an accident.
Ooh, nice.
Not predictable.
Exactly. They're a matter of chance. So when somebody says, oh, that was fortuitous, you would be using it appropriately if it was a matter of chance, not just lucky. Okay. I'm going to pause there. We've got just a few minutes left. I'm going to do a follow-up video on variance so that I explain it cleanly. Anybody have anything else they want to talk about, either about this chapter or anything from previous chapters? just as a reminder, let me find it. Where did I put it? The last week's review is up in the module 3 list for what we covered last Thursday, as well as all of the any videos that were posted would have been in that specific module for that chapter. But anybody have anything else they want to talk about? Carly?
You're saying, like, some of the questions even from the knowledge checks, were like, I definitely wouldn't ask those. So like, how would you classify the type of question that we wouldn't ask versus what we would?
I think that if you go back through any of the material that I covered in lectures, that is where I'm going to focus. Because those are the things that I think are most important. I've said a few times, I think that these first few chapters, I really hesitated to cover them as in depth as we did, because I didn't want you to walk away from this course thinking that that was the point, was for you to become an expert in any of these, the value at risk concepts, or even, variance, standard deviation, understanding the math behind it. You've got other opportunities that are going to challenge you on those terms. My main goal with this course is to have you be thinking about risk and the treatments of risk. Insurance isn't the only way out. There are lots of ways to deal with it. And to identify risk, because you'll be potentially working with clients. For sure, in your own life, you're going to be evaluating those risks. And I want you to be thinking about all of your options, as well as your own sort of risk tolerance towards, like, maybe you're somebody that can tolerate a lot more risk than somebody else. And so those concepts that we touched on that are more global are the ones that I think you're going to see on the test. There were, some of the homework questions I think were fine, and I think they were a good way of gauging. So I would still use those, as well as the quizzes for each of the chapters, as a way to prep. All right, anything else? Okay, well, I'll stick around for any questions that anybody has one-on-one. Otherwise, enjoy the rest of your first day back to maybe having in-person classes. Yeah.